Hi there, John Hardy here with the Saxo Bank FX update on this Friday, and as we sometimes do on a Friday, we're going to do a weekly wrap for the week, looking at today specifically, but hopefully giving a bit of a bigger perspective on what's going on for the week as a whole and what we're looking for next week. Today's highlights: we had weak U.S. data. We had a core CPI coming in below on the month-on-month expectations at 0.1%. The headline was in line with 0.5% expected, and the year-on-year was very slightly higher at 2.7 on the headline. But the surprise on the downside for the core, getting most of the focus if we look at the bond market, and that perhaps as well feeding into a weak dollar in places, not as much in other places. I'll get to why in a moment with the goings-on with the euro, but we're seeing the commodity currencies higher against the U.S. currency today, and we're seeing risk a bit higher, despite the relatively negative confidence data, for example. Perhaps looking over at Eurodollar stirs and the rally at the short end of the curve there, suggesting that perhaps people upping the ante on the likelihood of QE3 and this liquidity train lasting forever trade. Pretty gross for all of us free market people that like to see what the market would do without the presence of this Fed, but that may be one of the reasons we're seeing a risk up a bit today, and bonds up as well. We did, though, have a strong U.S. Empire manufacturing data point. This is the first of the major U.S. regional manufacturing surveys, so that was interesting. Basically every sub-indicator looking healthy there, as that resilience continues in the U.S. manufacturing sector. Importantly, on the euro side of things, Greece trying to stave off a default, trying to get its fiscal house in order, promising new austerity measures. I had some of the numbers out in this morning's written report, and promised to auction off, I think it was 50 billion euros worth of assets in the coming few years. Market not terribly impressed. We're really seeing these Greek spreads blow out and looking possibly at a restructuring. So the market is starting to price in. I know that you have to be pricing it in when Greek, a 2-year debt is trading at, I think it was 18%, and you're not going to get Greece financing anything at 18%. Basically 18% represents what people think. The price of 18% yield reflects what people think they're going to get out of a restructuring kind of deal, what kind of haircut they're going to suffer. And unlike in recent history, whereas this has been sort of contained to the smallest nations, and the market was blithely buying euros and ignoring that development because it doesn't seem to be showing any transmission to the other key eurozone core countries, like especially Spain being considered sort of the weakest of the major core countries. That has changed over the last couple of days. We've seen spreads blow out a bit. I'll get to that chart in a moment, and that is why we're seeing euro relatively weak, even though it hasn't dropped that much against the dollar, considering how poor the U.S. data came in and how heavily the U.S. rate outlook was affected by it. I think it's a very weak performance on the day for Eurodollar, which has been trading in a range now. So, but of course, this is more of a euro-specific factor, and euro looking fairly weak again after this data point. The question being, of course, does it spread wider on the rate side of things for ECB, etc.? This was not particularly affected, but it did affect the sovereign debt spread situation, and that's going to bear plenty of watching next week. In other news, of course, commodities being so much in focus, we have to keep an eye out there. We saw U.S. crude prices recovering quite strongly, looking at 109.50 or so, up $1.50 almost on the day for U.S. I think the Brent crude was up slightly less than that. We're still off those recent highs, but they're up on the day. And interestingly as well, precious metals seeing, especially gold, really perking up today. At 14.86, I'm seeing on the June future, and silver at a new record price. There's rumors, by the way, this is worth following, obviously, and this could cause an incredible spike if it comes to fruition. Rumors and fears that Bolivia may be looking to nationalize to some degree its mines, and of course, while I'm not a silver expert, obviously a significant percentage of the silver that is mined in the world comes from Bolivia, and this could get a supply panic going in the market. There's all kinds of rumors and to-dos about how many paper contracts have been sold versus what the actual market can supply, et cetera, et cetera. So there's a lot of shenanigans there that could cause further potential for crazy action in the silver market, not to mention the overall theme of currency debasement and the credibility of the Fed, etc. Looking at the themes, you still have the picture of, the dollar is doomed, et cetera, until the Fed stops the QE2 and doesn't continue with QE3. I think this is going to be a very large fear in the corner of everyone's mind. We have China. I think, to me, this seems to be the noise level on a number of fronts is getting higher. The whole Chinese situation is awfully opaque. You have to rely on a lot of anecdotal stories. We had strong data out overnight, but we're also seeing stories of house price drops on the order of 25% month on month. Of course, affordability in China and the rate at which these prices ramped is just almost unprecedented in world history. If we're to believe Chanos, where we have Dubai times 1,000 over in China, who knows? The timing, we've been talking about this for a long time, a number of the China skeptics have been talking about this for a long time. Is this something that plays out in the coming few months? Or are we talking another year and a half? It's hard to tell. It just seems to me the noise level is increasing. I think it bears scanning in the news, and hopefully we'll continue our coverage of anything that develops there in coming days and weeks. Interesting to see precious metals spiking higher, oil rallying, etc., and Goldman continuing to talk commodities down. Like I said yesterday, the cynics would say this is because they want to buy some more, but I think interesting to note that. And of course, gold is so influential in the market, so we have to be aware of whatever they're saying. And on a sort of a fundamental note, macro note, our low bond yields, which we've seen quite a rally here in bonds and yields dropping, our low bond yields and high commodity prices. Sorry, I should have written high commodity prices. Write it in here live on screen for you, since I've neglected to do that earlier. Are they compatible? And I pulled up, created, if you will, a chart here showing the CRB index in white. So we saw it bottoming out. Again, as we were going into the summer of 2010, we had a lot of fears of an economic slowdown. We had bond yields dropping as risk appetite was generally not doing so well. At least I think it was bottoming in early July on risk appetite front. Regardless, commodities were rather flat. Bond yields were dropping as the Fed seemed to be in an exit strategy, etc. And then we had the late August Bernanke move suggesting QE2 is on the way. And look how commodities shot up like straight up from that point on. And we've seen them rally to this day. Bonds, however, despite everything that's being done, everybody hating them to absolute death, have been rather flat over this period, and they've actually dropped a little bit. We did see a rally recently. This is the March 11th Japan situation and recuperation here, but it's interesting to see them coming off. And is it compatible to see people investing in long, for example, U.S. Treasuries and commodities at the same time? One would think not. So one of these markets is right, one is wrong. We tend to like to follow the bond market, and I would say, as long as there's no QE3, this could be suggestive of what the free market is thinking for bonds. Whereas here we had an awful lot of distortion created by the whole expectations of QE2. Once QE2 was fact, we did see, of course, a massive sell-off in bonds here, which was very interesting. And a lot of this was also caused by the Fed. So, in other words, once the Fed is out of the picture, what happens in these markets is a very critical long-term factor here. And I think it's very interesting we saw this recent rally in bonds. And until it's wiped away, I think it raises big question marks for what the market is thinking here and trying to pump this currency debasement theme, the dollar's doomed type theme. So we'll keep an eye on that development as well. Looking ahead, key one I haven't picked up on sufficiently. I may have mentioned it way back, but this is now becoming a news item this weekend as we have Finnish elections. This is very important because Finland is a key sort of core EU member. There's a great coverage of this from our chief economist, a video. I'll post a link to that. And I did post a link to that to Twitter earlier. Basically, they've got, I think, about a 16% rating in the polls. This is an anti-EU party. They don't want to vote for any bailout packages, etc. And in Finland, you are required to have a parliamentary vote rather than a government saying yes or no to Eurozone initiatives, the parliament has to vote, and I guess it's a simple majority. And with that party increasing influence, and the rumors that the Social Democrats in Finland are leaning somewhat towards Euroscepticism as well, you wonder at what point there's a quorum for rejecting Eurozone proposals. So this is very, very important. Any Eurozone initiative requires unanimous votes from its members. So suddenly you can have a nation like Finland, which I believe has something on the order of 5 million people, looming rather large in the bigger Eurozone picture. And I think it's also a symptom, as we're seeing in other Euro countries as well, of the lack of popular interest in the whole Eurozone project and in these bailouts. And we still have to keep that in mind as we're seeing Spanish spreads widen. Of course, because if Spain moves into the danger zone, we have a whole different ball game in terms of bailout size, etc. And today in general, interesting moves in bonds and equities. S&P 500, that 55-day moving average, I've mentioned that before. Earnings going to be continuing on next week. I haven't listed that here, but watch out for the corporate earnings. I've seen 2 banks report out of the U.S. They're not lending money. They're writing down loss provisions to create profits, and even though they're doing that, they're generating pretty pathetic results. The revenues are down, etc. So we've seen financials lead the market before. Financials are very weak compared to the rest of the market. Is this leading the market lower? And certainly no technical sign of that yet. You could say there's some signs of exhaustion in the market, trend exhaustion here, but we need to see that 55-day moving average taken out again and momentum picking up to get a stronger technical case for the near term. Meanwhile, one could wonder if a pivot point could be coming on the way at the April 27th FOMC meeting. And don't forget, next week is Easter week. A lot of countries out for a significant portion of the week, Thursday, Friday, and Monday in some cases, Monday the following as well. Follow me on Twitter if you're interested. You can add me. My Twitter name is @JohnJHardy. And I've got a few charts today. Looking first at this picture, I sent a version of just the Spanish spread versus German debt in my written note this morning. That was on the 2-year. This one is just one I had already made on the 10-year, which is perhaps less good to use, but it still shows the same development. And this is showing the spread, average spread of Italy and Spain, the 10-year yield versus the German yield, and this versus Eurodollar, which is in the dark blue. And we're seeing as the spread narrows, I've got these this axis inverted. This is the spread in bips. As the spread narrows, it supports Eurodollar. Of course, the Eurodollar view also being supported by the interest rate expectation and the ECB hawkishness, but this is an important factor too, as we've seen in the past. This is actually dominated, when it gets really moving, is dominated more than the interest rate spreads from central bank views. So this is very important, and we've seen before how, for example, as the spreads really widened here, at first Eurodollar didn't take note. This is back in November of last year. Eurodollar even tried to rally, but look how the spreads really made the difference here, and it sold off. Again, here we had a new low in Eurodollar. The spreads hadn't quite posted a new low and rallied, and saw some support to the Eurodollar's rally cause there. Same has been the deal here of late. I think actually the 2-year picture is more consistently higher for Spain than this chart shows. But in any case, this big bout of nervousness over the last couple of days has removed one of the supports for a Eurodollar rally. The other support, however, is still in place, that being the ECB expectations, especially after today's weak U.S. data, which saw quite a strong rally. In fact, I think I have that right here. This is the June, and this chart, thank you Bloomberg for this chart. This is the Eurodollar stir for June 2012, and the reactions to that CPI data, etc. Today, seeing this back not that far from the highs of the cycle. In other words, the higher this goes, the lower Fed expectations become. And we're from this range here, we're about 25 bips off of the highest expectations we've seen from the Fed. So that's pretty significant, feeding into those interest rate spreads. And speaking of interest rate spreads, we've got a chart of those. We've run through these before. Here's Eurodollar. Actual spot is in red, and the swap spread itself for 2 years is in blue. And we're seeing that it was rangy for a while. It's broken out recently, sort of actually broke out before the the swap spread, the currency pair. Sorry, the currency pair actually broke out before the swap spread did, but obviously very correlated. And the other key factor being, of course, sovereign risk, and whether that risk is the risk of contagion spreading. Now, cable hasn't behaved so much lately. We have seen pretty good behavior. We saw spot, or sorry, we saw spot much higher here when we'd seen a general contraction in the spreads over this time period, and we noted that, and finally the fundamentals established themselves. Then we saw some very tight correlation in here, and now we've got cable rather high relative to the rate views. It just shows you that the Bank of England is pretty much expected not to do relative to what we were looking at a couple weeks ago after some recent UK inflation data, that really the continued range trade is what is supported for now. The only thing that would support a cable rally higher would be if there's a generalized dollar panic, one would think. Kiwi, we've shown this in the past as well. We actually have seen a tightening here, or actually a widening, I should say, in the spreads. The swap differential now at 2.5% plus. After the general direction was right here, then we saw it shrink even more. The spread differential, while Kiwi rallied, the idea could be that funds flowing into New Zealand for rebuilding. Certainly Kiwi a very popular currency at this moment in time, as is Aussie on the whole commodity theme, debasement theme. These countries are low in sovereign debt, etc. Question being, what happens if Goldman is right on commodities? We have very strong proof that Aussie is a commodity currency. We showed that chart versus BHP stock, for example, BHP Billiton, and that's going to be the only thing that turns around this Aussie rally, is if people stop moving on this commodity trade. Interesting to note, by the way, this looking at copper just now, it's pretty close to a month low here. BHP stock is still very elevated, however. So it looks like people are trying to see the glass half full and looking at silver and gold rather than copper, but I would say copper is equally influential. So certainly some tension there in that view. We have seen, however, the spreads widening a bit here, somewhat supporting this, but before that they had been sort of going in opposite directions. Euro-yen finally calming down a bit on the swap differential, flattening out a bit recently, and spot has flattened out and gone down with this latest rally in bonds, where bonds are finally starting to get a little bit of traction on consolidating as well. Previously it was more the U.S. that was rallying. Now we got bonds joining the government bond rally here. Dollar Canada supported lower by oil more than the spreads, though we are at the low part of the range of the last 4 or 5 months on the spread differential. Euro Stocky, perhaps the sell-off a bit too enthusiastic of late on this, but still tracking pretty much the interest rate differentials. And Euro Sterling suggesting that it could be even higher, though I would suspect that Euro Sterling might be a bit more sensitive than, for example, Euro Dollar on the whole issue of whether there's a contagion risk to Spain, etc. But again, if we're looking purely at an interest rate differential perspective, the support is there for a move even higher. And these are by no means, this is just a visual matching of the two charts. This is not meant to say that we should be trading at 92. It's just suggests that the pressure could be higher if, as long as the sovereign debt contagion situation doesn't spread. If we have a look at charts, we have Eurodollar here, and we had an old rule of thumb, that is, if we don't see follow-through after X number of days, that the risk of a consolidation rises. Now we've seen a whole week of just nothing happening after this initial strong bar higher, so I would say it raises the risk of a consolidation down to the 142.50 area, which was the key zone, resistance zone on the way up. And of course we have this very well established trend line as well, key to watch on the Eurodollar. Cable, again with our interest rate spread picture suggesting that the thing should be back down in the range, even possibly back towards the bottom of the range. but of course, a close above 164 raises the fear of a breakout, and again, that would only come to me on a dollar panic of some kind. And we've certainly seen 1, 2, 3 false breaks here. So this one's been very unreliable as a trending, any kind of trending indicator on breaks, and the dominant outlook remains one of range trading, and our fundamental models suggesting it should remain in that range for now. Look at this low here next week. Euro sterling, again, the spread suggesting it should be higher, but we have the introduction suddenly, and this is very novel for the last couple months, of the Spanish spreads going wider. So that's I think going to be a more important factor going into the next several days of trading. Euro Swiss unable to find that support today, or follow up on it on the hammer so far anyway from Thursday. The reason for that, in my mind, strong rally in bonds, as this helps out the lowest yielders when we see treasuries getting a bid. And the same goes for Euro Yen, where this nice reversal, which looked nice and bullish, seems like to me, I don't know if it's just me, but every single reversal setup of late has just been an absolute failure. And that's, I don't know what that's supposed to be a sign of, but it sure is interesting. And the last time we saw a very good reversal here, that one was awfully good. This was a nice reversal indicator. But a lot of the more recent ones, and I'm not just talking about Euro Yen, but in general, have seemed very unreliable for indicating direction. There's plenty of room for this to move around before it looks like any kind of reversal from a bullish market. So we're going to have to watch and see where and if that finds support. Dollar Yen as well, and trying to make a case for the 200-day moving average moving below again. I think that certainly raises the odd tactically of this. Look at this 82.50 area for Dollar Yen. There's crude oil market. It's higher today, but we still have this massive top here, a few dollars higher still to consider. Let's see if the sell-off gets a follow-up though. On Dollar Canada, uncertainty. We saw the rejection yesterday. Hasn't followed up so far. I think of a very clear line in the sand on the upside there, etc. Around 96.50, 60, 70 area. This high is. Obviously, anybody looking to buy the thing would want to look at whether that breaks and holds first. Aussie dollar losing a bit of momentum if we look at the 1, 2, 3 days, each day being a smaller incremental gain on the day. 105.80 the resistance there. Kiwi, if you like, we tried looking at whether there was a bearish case yesterday, got completely rejected on that. If you like to believe that things can go up forever, I guess you can jump in, but this one I think whenever it finally does find a top, whether it's here, whether it's 85, I think it'll be very interesting and rather rapid fire turnaround. On the Aussie Kiwi, we've been a bit more right and looking for a top to stay in at 135, and that's gotten some good follow through there. I think that's an interesting trade, an interesting potential further bearish scenario there, as long as that 135 stays in place, looking possibly to the bottom of the range eventually. Emerging markets doing generally very well, along with risk appetite. And there we are back at crude again. Let's see the S&P, again, this 55-day moving average, a really critical one. Keep an eye on that for a broader risk indicator. Here you can see how much Bank of England expectations have been deflated over the last week. This is key for tearing out the support from under any further sterling rally for now, unless we get compression. Excuse me. Unless we get compression in the spreads from other sources. We've seen some of the ECB expectations come out as well, but not nearly as much as we're seeing out of the US and UK expectations. Looks like I've done it. I've managed to make a record-length video, not by any intention. I'm sorry if these are too long for you. Appreciate your feedback in any case, negative or positive, or anything else you'd like to see. If you've made it this far in the video, congratulations. In any case, have a wonderful weekend, and we'll be back next week with further editions of the Saxo Bank Video FX Update. Take care out there.